So last week I talked about interest rates, Robinhood's 4.9% return, and how to beat their return without paying for their premium gold membership. Now, I got a lot of comments out of this subject, more than I got in a long time. So I want to thank all of you who shared your comments with me. But I also promised you something at the end of last week's video. Can we create a risk-free trade with interest rates this high? The short answer is maybe. The long answer, well, that depends. So let's not create just one, but 3 potential risk-free trades over the next year. Let's get to it. Hey folks, Tom Gentile here. Today we're talking about risk-free trades. Now let's do a quick review. Last week I mentioned you can get 4.9% interest on uninvested cash in your Robinhood account. I also mentioned that if you need about $10,000 or more in Robinhood, otherwise you're going to take a big chunk of that 4.9% in their gold membership fees. And I also mentioned to get the returns that Interactive Broker is paying in your Robinhood account, you need $100,000 in cash in your Robinhood trading account. All right. Hey, finally, I talked about a workaround last week using SGOV. That's the bond ETF that's paying out right now about 5.28% annualized. In fact, as of this week, SGOV declared a 44-cent cash dividend per share, as noted from my brokerage account transactions. Check this out. And if you didn't see last week's video on this, then check it out for all the details. So if all remains the same, this would amount to a $10,000 account being worth $10,528 in a year. That's $528 of risk-free income that could be used for anything. But in this case, let's look at trades that cost no more than that expected income above. So the overall plan here is to go long the market so that if interest rates drop, the idea is that the market would move swiftly higher, offsetting the drop in interest rates and interest income. So I want to look at 3 trading ideas today involving options. Number 1, buying long-term call options on SPY. Now, SPY is the ETF that tracks the S&P 500. Buying call options gives you the right, but not the obligation, to purchase the underlying instrument at a set price for a set time. You're going to pay a premium for that right, and your cost and risk is that premium. So what's available right now with a year to expiration that costs around $500? Check this out. Buying a 1-year SPY 535 call option will cost you around $500. To calculate break even on a call option, that's easy. You simply add the premium paid to the strike price, the reward's unlimited, and you're betting on the overall market climbing hard into the upcoming election year. Now, again, as you look at the chart here, you're going to see that we've got a maximum risk that goes below 535. You've got a break even on this at 540, and you've got upside that's above 540. That's what a call option does for you. Can we find something else? Yeah. How about number 2? That is the long-term vertical call spread. Now, call spreads are the simultaneous purchase and sale of 2 different strike prices using the same expiration date. So for an idea, you would buy a lower strike call, sell a higher strike call. The strike sold is going to help offset the strike that you buy. So it's still going to be done at a debit, but the strategy is done to lower cost or lower your break even, sometimes both. And it also allows you to increase the reward to risk ratio. So what looks good in the area of SPY right now with a vertical call spread? Check this out. So in this example, we're buying the SPY 515 535 call spread, which is coming at a cost of about $425. Now, our break even of $519.25, that's determined by adding the cost of the spread to the lower strike price. So lower strike price plus premium, that's the spread premium, equals break even. We can even calculate our max return of $1,575 by taking the difference between the strike prices and subtracting the premium. Now, I call this the shotgun approach because even though your reward is limited, your trade-off is that you have a lower break even. And the third idea for taking our $528 of interest income and applying it to the markets would involve a long-term butterfly, or what I like to call the long call butterfly. The call butterfly consists of 3 different option strikes using the same expiration dates. So moving up from today's stock price, what you're looking at doing is buying 1 out of the money call, selling 2 further out of the money calls, and then buying 1 even further than that out of the money call. So you're +1, -2, +1. That's what creates the call butterfly trade. This is a low cost, limited risk, and limited reward trade. It's one of the best in terms of risk to reward ratio. All right. But you got to be very good with your stock price assumptions as you near expiration. The trade-off with this being such a low cost and such a high upside is that you have the way you get the major payoff is when you're very, very close to expiration. Let's take a look at some details. So with this particular trade we're looking at right now, it involves the SPY 505, 535, and 565 call strikes. Again, you're buying the 505 and the 565 calls. And for every 1 505 call you buy and 1 565 call you buy, you're selling 2 535 calls. This is how you make the limited risk and limited reward trade. The total cost of this trade is $442, but it has a maximum reward, as you can see, of $2,558. Now, for those of you who can do some quick math, that's nearly a 5.8 reward to risk ratio. Looks great. But again, in order to get that number, SPY has to close at 535 on expiration day, which is over a year from now. Now, this trade has 2 break evens on it. Means that you've got to be between 509.42 and 560.58 to be at break even or better on expiration day. Yeah, you can exit early, but the real money's made in staying in this trade as long as possible. So, which one's best? Least risk, greatest reward, best break even, or is there something else? What do you think? Share your comments with me below the screen. While you're doing that, I'm going to show you how I compare these for my own assumptions. So what you're looking at right here is a comparison sheet looking at the call spread, the call spread, and the call butterfly. And these are all on 1-year options. So let's take a look at each column. Cost and risk. Since our plan is to take the money we make over a year from interest income, I really don't believe this number is relevant for comparison, but you could say the call spread ends up with the least cost if everything drops. How about reward? Well, this one could be up for debate, but unlimited stands out here. So I'm going to give it 1 point to the calls. Break even, in my mind, it's a number that's easy to calculate, but it's often overlooked. That would go to the call spread. Even though the butterfly has a lower break even, it also has an upper break even, which means it has losses above $560.58. Now, let's talk about 2 things we haven't discussed. Chance of a double and probability of that actually happening. I call these PTD and POP. PTD, or percent to double, is a mathematical formula that calculates the number the asset has to move for the option trade to theoretically double in value. Now, looking at that column, lower is better, and that mark goes to the butterfly. Probability of profit column, well, this can be calculated a number of ways, but what we're doing is measuring how probable this double is likely to be touched. So in this column, higher is better, and that award goes to the call spread. In summary, I have to say the call spread makes the most sense here because it's hitting both the upside break even and the POP, not to mention it's the cheapest. Now, keep in mind, this is just a few of dozens of trades that you can create with your newfound money awarded to you thanks to SGOV. Is it truly a risk-free trade? Let me know in your comments. I think it's up for debate. On one side, using money from one investment to fund another, it's a maybe. But on the other side, nothing remains the same with an asset like SGOV. So maybe not. So I'm going to repeat what I said last week. Interest rates will fluctuate, so you should never expect for this dividend to be the same payout each month. That being said, whether you think this is truly risk-free or not, I think it's an interesting way to play both the stock and the bond markets. Thanks for joining. I'll see you next week.